If you have ever wondered that why the price move against you right after when you enter in the trade, so actually you are trading against the smart money. So in this video I will break it down what is smart money and how you can trade with them, not against them. So first of all, understand what is smart money. Smart money, it means actually the big players of the market. I mean banks, hedge funds, institutions, big whales. These are the big players of the market. They can control huge amount of money to move the market. They can never trade like retail traders. They can trade with a smart way. They can create moves to trade the retail traders. Now how the retail traders can lose money in front of the smart and big players. So actually the retail traders can trade on the behalf of news, signals and others, technical and fundamental analysis. So you know what, the big players, I mean the banks, hedge funds, institutions, whales, they can push the price to trigger their retail trader stop loss and entries, and this gives them liquidity to fill their big position. So before we understand how the big players can trade in the market, first you need to understand these three things: market structure basics, the second one is liquidity zone, and the third one is order blocks. So first one is market structure basics, like I mean how the market structure works. So you can see on the chart the price moves on a highs, lows. This is not gonna doing randomly. The big players, the whales, the banks, institutions, huge funds, they're gonna move the market during consolidation pattern. When you can see the consolidation pattern in the chart, this is the best opportunity for these big players. I mean they can trigger the retail traders, they can trade the retail traders, and then they can move the market in the real direction. So this is the market structure based zone. Now we understand the liquidity zone. What is this? Actually these are the zones in the chart where majority of stop loss of retail traders, their stop losses and a lot of pending orders are sitting. And you know what, these big players, they can target these zones, and once they can target, they can move the market in their rear direction. Now let's talk about the order blocks. Think of that like in the market you can see there is a fight between buyers and sellers. Buyers, the retail buyers like us, we can buy small amount of trade, while the big players, they can trade so big. So they can never do like us, click on the buy or sell at a time. I mean they can never buy or sell all of their trade at a time. They can buy very slowly. They can place their order slowly instead of buying a lot of trade at a time, because they don't want that everyone can be alert for the big move. Imagine, like I mean you can see in the chart, the chart moves slowly and then boom, a very big move come in the market. So the before the big move in the chart, you can see small charts, small candlesticks can be made. So this is called order blocks, in which the big traders can buy small amount of trades in a specific period of time. Like I mean they never want that everyone can be alert and everyone can knows that after this specific of candle the market can move up. So this is called an order block. So now how can you spot the big players move? The first one is sharp spikes into liquidity zone, then quick reversal. The second one is break of market structure after fake outs. Like I mean sometimes you can see in the market there is some fake breakouts comes just to trigger the retail traders. And the third is volume often increase just before a reversal. Sometimes you can see the volume can be very increased suddenly, like the chart in the chart there is nothing shown, but the volume suddenly increased. So this is the point where the big players can come in the market. Here are some common mistakes which majority of retail traders can gonna do, and that's why they can lose money. So the first one is they can enter in the market at the exact point of the liquidity grab. Like I mean you don't need, you just wait for the confirmation. The second point is ignoring the higher time frames. Like I mean they can trade in the lower time frames, 5 minutes, 15 minutes charts, and that's the big mistakes. Because of that you can lose money. Like the big players, they can trade in the higher time frames, 1 hour, 1 day or charts, or the retail traders, when they're going to trade in the lower time frames, so they have no idea in which direction the market can be moved. So always use the higher time frame for the confirmations. And the last point is that think of that every point is the smart money trap. So like, I mean, you don't need to think like this. Sometimes the market can be moved in the trends. Like, I mean, when you can see the market is moving in uptrend direction and you are waiting that this is the trap and I can never enter in the market, so you can miss a big opportunity. So always trade with a smart way. Always think like the smart people, and and your success of chance in the trading can be increased. So start looking to the charts, to the trading on the eyes of smart money, and then you can see, you can notice a pattern which you have never ever seen it. So if you want that I can make a video for you on the order blocks step by step, so comment me, and I hope you're gonna get some good value from my video. So like the video and subscribe my YouTube channel. Thank you so much.